think TDS is the final step in taxation. Not always. Whether it is advanced tax, entity-wise taxation, investments through joint bank accounts, changes in tax laws, or pre-investment tax due diligence. Understanding these aspects can help you avoid surprises and make better financial decisions. In this video, we'll break down the advanced level tax structure of ghlindiaasset secured NCDs in a simple and practical way, so you can invest with greater clarity, confidence, and tax awareness. Let's dive in. One, is advanced tax applicable on NCD interest income? Yes, depending on an investor's overall tax liability, advanced tax may be applicable on the interest earned from secured NCDs. Although GHL deducts TDS at 10% under Section 393 of the Income Tax Act 2026, subject to applicable law, this TDS is only an advance collection of tax. It may not fully discharge the investor's tax liability. If the investor's total tax liability exceeds the prescribed threshold under the Income Tax Act, after considering TDS and other tax credits, advance tax may become payable. Why can advance tax still be payable? Many investors assume, since TDS has already been deducted, I don't have to pay anything further. This is incorrect, as TDS is merely a tax credit. The final tax payable depends on total annual income, applicable tax slab, other income sources, total tax liability, TDS already deducted. If there is a shortfall, advance tax may have to be paid in accordance with the Income Tax Act. Example, suppose investment 1 crore rupees, interest at 18% equal to 18 lakh rupees, TDS deducted at 10% equal to 1,80,000 rupees. If the investor falls in the highest tax bracket, the final tax liability on this interest may exceed 1,80,000 rupees. The balance tax may need to be discharged through advance tax or self-assessment tax as applicable. Who should pay particular attention? Advance tax becomes particularly relevant for high net worth individuals, HNIs, business owners, professionals, investors with multiple income sources, because their total tax liability often exceeds the TDS already deducted. How can investors ensure timely tax compliance and avoid additional tax liability? Investors should estimate annual taxable income, consider all income sources, adjust for TDS already deducted, pay advance tax where applicable within the prescribed due dates. Consulting a chartered accountant is advisable for investors with substantial investment income. Important clarification: TDS is the beginning of tax compliance, not necessarily the end of it. TDS deducted on your NCD interest may not be your final tax. High-income investors should review whether advance tax is payable based on their overall tax liability. The applicability of advance tax depends on the investor's overall tax liability and the provisions of the Income Tax Act in force at the relevant time. Investors should consult their chartered accountant for personalized tax advice. Good investing includes good tax planning. Review your overall tax position, not just the TDS deducted. 2. Can HUF is, companies, LLP is, and trusts invest, and how is the interest taxed? Yes, subject to the applicable laws, the terms of the private placement, and the eligibility criteria prescribed by ghlindiaasset, investments may be made by eligible entities such as individuals, Hindu undivided families, EHUFs, companies, limited liability partnerships, LLPs, partnership firms, trusts, other eligible legal entities. The taxation of interest earned from secured NCDs depends on the legal status of the investor and the applicable provisions of the Income Tax Act. How is interest taxed for different investors? 1. Individual investors. Interest earned from secured NCDs is generally taxable under the head Income from Other Sources. The final tax liability depends on the individual's applicable tax slab and other relevant provisions of the Income Tax Act. 2. Hindu undivided family. Interest earned by an HUF is generally taxable in the hands of the HUF in accordance with the applicable provisions of the Income Tax Act. Companies. Interest income received by a company generally forms part of its taxable income and is taxed in accordance with the corporate tax provisions applicable to the company. For LLPs and partnership firms, interest earned by LLPs and partnership firms is generally taxable in accordance with the applicable provisions of the Income Tax Act. 5. Trusts. The taxation of interest earned by a trust depends on the nature of the trust, its registration and tax status, the applicable provisions of the Income Tax Act. Accordingly, trusts should obtain professional tax advice before making an investment. Does GHL deduct TDS differently for different categories of investors? No. ghlindiaasset deducts TDS on interest paid on secured NCDs in accordance with the applicable provisions of Section 393 of the Income Tax Act 2026, formerly Section 190 of the Income Tax Act 1961. Accordingly, the TDS deduction mechanism remains the same for investors covered under the applicable provisions of the Act. However, the final income tax liability of each investor may differ depending on factors such as the legal status of the investor, individual, HUF, company, LLPs, trust, etc., a total taxable income, the applicable tax slab, a tax regime chosen, other applicable provisions of the Income Tax Act. Therefore, while GHL deducts TDS in accordance with Section 393, the ultimate tax payable or refund available is determined based on the investor's individual tax profile. Why is this important? Two investors may receive the same amount of interest from identical secured NCD investments. GHL may deduct TDSs in the same manner as prescribed under the Income Tax Act. However, their final tax liability may differ because of differences in their taxable income, legal status, tax regime, applicable tax provisions. Therefore, investors should always evaluate the investment based on their post-tax return rather than only the pre-tax interest rate. Important clarification: the TDS deduction is governed by law and remains consistent under the applicable provisions, whereas the final tax liability depends on the investor's individual tax profile. Many investors believe that if their final tax liability is different, the company must also deduct TDS differently. This is incorrect. GHL deducts TDS in accordance with the provisions of the Income Tax Act. The difference arises only while computing the investor's final tax liability. Whether you invest as an individual, HUF, company, LLP, or trust, GHL deducts TDS in accordance with Section 393 of the Income Tax Act 2026. What changes is not the TDS deduction, but your final tax liability based on your own tax profile. The eligibility of an investor to subscribe to the secured NCDs and the taxation of interest income are governed by the applicable provisions of the Companies Act, the Income Tax Act, and other applicable laws. Investors are advised to consult their chartered accountant or tax advisor for advice specific to their legal status and tax position. TDS follows the law. Final taxation follows the investor. 3. If the investment amount is received from a joint bank account, how are the debentures allotted and how is the interest taxed? ghlindiaasset accepts investment funds from a joint bank account, provided the remittance complies with the applicable onboarding, KYC, and banking requirements. However, the secured NCDs are allotted only to the applicant whose name appears in the registration form and whose KYC has been completed and accepted by the company. Accordingly, the debentures are not allotted jointly merely because the investment amount is received from a joint bank account. Who is recognized as the debenture holder? The legal debenture holder is the person named as the applicant in the registration form who has completed the prescribed KYC process, in whose name the secured NCDs are allotted. The source bank account does not determine ownership of the debentures. Who receives the monthly interest? Monthly interest is paid in accordance with the terms of the debenture issue. For tax purposes, the interest is considered payable to the registered debenture holder, subject to the payment instructions and applicable legal requirements, in whose name is TDS deducted. Since the debentures are allotted to a single registered holder, TDS is deducted in the name of the registered debenture holder. TDS is reported against the pen of the registered debenture holder in accordance with Section 393 of the Income Tax Act 20, formerly Section 193 of the Income Tax Act 1961. The joint bank account holder who is not the registered debenture holder will not receive TDS credit merely because the investment amount was remitted from a joint account. Who should report the interest income? The interest income should generally be reported by the registered debenture holder since the secured NCDs are allotted in that person's name. TDS is deducted against that person's PN. The tax reporting is linked to that investor. The tax treatment remains subject to the applicable provisions of the Income Tax Act. Why does GHL follow this process? This process ensures clear legal ownership of the secured NCDs, accurate KYC compliance, proper TDS reporting, correct investor records, efficient servicing throughout the investment tenure. It also avoids ambiguity regarding ownership, tax reporting, and repayment at maturity. Important clarification: the source of funds does not determine ownership. The legal ownership of the secured NCD is determined by the registered applicant and the completed KYC. Many investors assume that payment from a joint bank account automatically creates joint ownership of the investment. Under GHL's investment process, ownership is determined by the registration and KYC record, not by the source bank account. Even if the investment amount is transferred from a joint bank account. GHL allots the secured NCDs only to the registered applicant who has completed the KYC process. The bank account does not determine ownership. Acceptance of funds from a joint bank account is subject to GHL India's internal onboarding policies, KYC verification, banking requirements, and applicable laws. The allotment of secured NCDs is based on the approved registration and KYC records maintained by the company. The bank account facilitates the payment. The registration and KYC determine the legal ownership of the investment. 4. What happens if tax laws relating to debenture interest change during the investment tenure? The taxation of interest earned on secured NCDs is governed by the Income Tax Act and other applicable laws in force from time to time. If there is any amendment to the Income Tax Act, the applicable tax rules, TDS provisions, or any other relevant legislation during the tenure of the investment, GHL ghlindiaasset will comply with the revised legal requirements from the effective date of such changes. Accordingly, investors will also be subject to the applicable tax laws prevailing at the relevant time. Can tax laws change during the investment tenure? Yes. Tax laws are amended periodically through Finance Acts, amendments to the Income Tax Act, notifications, circulars, rules issued by the Central Board of Direct Taxes (CBDT). Such changes may affect TDS provisions, tax rates, compliance requirements, reporting obligations, other tax-related matters applicable to the investment. What happens if the TDS rate changes? If the government amends the applicable TDS provisions for debenture interest, GHL ghlindiaasset will deduct TDS at the revised rate prescribed under the law from the effective date. The revised TDS will apply prospectively in accordance with the applicable legal provisions. Will such changes affect the investment? Changes in tax laws generally affect the tax treatment of the interest income, but they do not alter the contractual terms of the secured NCD unless required by law. For example, a change in TDS provisions affects the amount deducted as tax at source, but it does not by itself change the agreed coupon rate under the debenture terms. How will investors be informed? If there is a significant change in the tax provisions that materially affects investors, GHL will communicate the relevant changes through appropriate investor communication channels, wherever required or considered appropriate. Why does GHL follow this approach? As a responsible issuer, GHL is committed to complying with all applicable tax laws, deducting and depositing TDS as required by law, maintaining transparency with investors, keeping statutory compliance aligned with the prevailing legal framework. Important clarification. Investments are governed by the contractual terms of the secured NCD, while taxation is governed by the law in force from time to time. Some investors assume that the tax rules applicable on the date of investment will remain unchanged throughout the tenure. In reality, taxation is governed by the law in force at the relevant time, and legislative amendments may apply prospectively. Tax laws may change during the tenure of your investment. If they do, GHL ghlindiaasset will comply with the revised legal requirements, and the applicable tax treatment will follow the law in force at that time. The tax treatment described in this video is based on the provisions of the Income Tax Act and other applicable laws as on the date of publication. Any subsequent amendments enacted by the government shall prevail, and GHL ghlindiaasset will comply with such amendments from their effective date. Investors are advised to consult their chartered accountant or tax advisor regarding the impact of any changes in tax laws. Investment terms are agreed by contract. Tax treatment is determined by law. 5. What tax due diligence should investors perform before investing? Before investing in any secured NCD, investors should evaluate not only the return on investment but also the tax implications associated with the investment. Proper tax due diligence enables investors to understand their actual post-tax return, avoid future tax disputes, and ensure full compliance with the Income Tax Act. At GHL ghlindiaasset, we encourage every investor to understand the tax implications before making an investment decision. Tax due diligence checklist. Before investing, investors should consider the following. 1. Understand how the interest is taxed. Confirm that the monthly interest earned on the secured NCD is generally taxable in the hands of the investor under the applicable provisions of the Income Tax Act. 2. Understand the applicable TDS provisions. Investors should understand the applicable TDS provisions under Section 393 of the Income Tax Act 2026, formerly Section 193 of the Income Tax Act 1961. The current TDS rate applicable to debenture interest. The consequences of not furnishing a valid PIN. 3. Evaluate the post-tax return. The advertised interest rate should not be the sole basis for an investment decision. Investors should evaluate gross interest income, applicable income tax, net post-tax return, monthly cash flow after taxes. 4. Verify PN and KYC details. Ensure that PN is correctly furnished, KYC documents are complete and up to date, bank account details are accurate. This helps ensure proper TDS reporting and seamless tax credit. 5. Understand your tax profile. The final tax liability depends on factors such as individual or entity status, total taxable income, applicable tax slab, tax regime selected, other sources of income. 6. Understand TDS credit and tax reporting. Investors should know how TDS is deducted, how to report interest income in the income tax return, how to reconcile Form 26AS, AAS and Form 660A, how to claim TDS credit. 7. Consult a chartered accountant. For substantial investments, investors should obtain professional advice to understand tax liability, advanced tax obligations, cash flow planning, post-tax investment returns. Professional advice helps investors make informed decisions based on their individual circumstances. Why is tax due diligence important? Many investors compare investments based only on the stated interest rate. However, an informed investor evaluates pre-tax return, post-tax return, tax compliance, cash flow impact, documentation requirements. This provides a more realistic understanding of the investment. Important clarification. The smartest investors don't just calculate returns. They calculate post-tax returns and understand their tax obligations before investing. Many investors focus entirely on the interest rate and overlook the tax implications. A well-informed investment decision should always consider the post-tax return, TDS provisions, and the investor's own tax position. Before investing, don't just ask, what's the return? Also ask, what's my post-tax return? How will TDS be deducted? What will be my final tax liability? Smart investing begins with smart tax planning. This video provides general guidance on tax due diligence for resident Indian investors. The actual tax implications may vary depending on the investor's legal status, taxable income, applicable tax regime, and prevailing laws. Investors are advised to seek independent professional advice before making investment decisions. A successful investment is not measured by the interest you earn. It is measured by the wealth you retain after taxes and compliance. Knowing how your investment is taxed is important, but knowing how it's protected is equally important. In the next episode, we will begin the basic level of risk management and investor protection, where you will learn how investment risks are identified and managed, how investor capital is safeguarded, and why investment risk is not the same as capital loss. More insights, more confidence. See you in the next episode.